All right, let me put these tech worries in perspective. This morning, Kohl's, KSS, a department store chain that mistakenly my charitable trust had not a big position, but owned a position in, reported what I regard as a massively disappointing quarter. Although to listen to management, you think that they had some sort of blowout. They were congratulating themselves. It was a head scratcher, which is something I advise you not to do if you have as much spray-painted makeup on or you'll get a lot of dirt on your fingernails. I think Kohl's is in an existential crisis, frankly. It's going full Jean-Paul Sartre. You don't pronounce the R-E. We're in a period of monumental turmoil for retail where the only real survivors will be the companies that dominate in the off-price space or the ones that dominate online. Kohl's? KSS? Kiss me, stupid? It does neither. It has to find a way to either become the lowest cost seller, which I don't think it has the ability to do, or it has to spend fortunes to develop a digital strategy that's good enough to compete with Walmart or Target or Amazon. And I don't think they need to. After listening to today's call, I don't think it's possible. Because management seems to be in total denial about how much it needs to spend on tech before it can even get in the game. They think they're doing great. Hey, when you're doing great and you're not, well, that's how your stock that's how it goes down 20% like it did today. But the lesson here is simple. If you want to stay competitive in retail, you need to pay these software as a service companies a fortune. Yeah, you got to write them big checks. That's why I rebel against this idea that you need to lighten up on tech because it's because there's too many people who own it. I mean, it's a club too crowded. I mean, come on, the tariffs will hurt. No, indispensability. How about the biggest companies on earth, Microsoft and Apple? Worry about those? Microsoft remains omnipresent, but they've done such a good job of diversifying away from the plain old PC business that I can't imagine their numbers being hurt that much by China. It's Azure is really the king there. That's right, their cloud business. Apple? Trade will always be an issue with Apple because they can't afford to turn their backs on roughly 1.5 billion people in China. But Apple's managed to thread the needle during the trade war because they've created millions upon millions of jobs in both countries, and it has the confidence of both leaders. In short, they may just be able to transcend the whole conflict. Wow, hats off to Tim Cook. Oh, let's not forget the rest of FANG. There's Facebook, Alphabet, Amazon, Netflix. These companies have no Chinese exposure to speak of, and when you ain't got nothing, you got nothing to lose. Thank you, Bob Dylan, at least in earnings per share. So here's the bottom line. If you feel compelled to sell tech, ask yourself what you're selling. If you're dumping an ETF, be my guest. Those are just moronic amalgams of stocks slapped together by people who make a living by convincing you that the tech sector is a real cohesive thing. But if you're dumping the kind of tech stocks that are working here, especially the better-run software as a service names, I think you make a big mistake, and one that you'll regret when this trade war eventually blows over, and it will.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.